All right, so we're back to the all-time highs. S&P blowing past all-time high 73.50. These are the futures. It's a little higher than well, it's early in the month, and the futures are for the close of the month or the close of the quarter, actually. So, um, so when you're looking at them, that's where people expect that's future expectations. So people generally expect the futures to be higher in a month or so. Therefore, they're going to reflect a higher number than what we're actually at. That's what the futures are about. It's the same thing with an oil future. An oil future is predicting where we're going to be, not today, but no, not today, where spot oil is going for a lot of money. Do I have that? Mm-hmm. See, cash oil is still $102, and it was 106 yesterday. So for cash oil, you're paying 102. The June contract delivery next month is what's trading at $95. Still, though, you look down the strip and we're still at $90 in July for July delivery, $88 in August. So it's not coming down that quickly. And anyway, so these are future expectations. So right now, if you want a barrel of oil, you're going to pay 102. If you want to order a barrel of oil for June, you can pay 95. So the expectation of the futures market is that prices will be lower in a month. That's basically what it's saying. So it's the same thing when you're looking at the index futures. It's it's not what it is now. It's what do you think it'll be in a month. And so that's very important to keep that perspective when you're looking at things. Anyway, now the most important thing I think we got to talk about is this, because in the last month, 1 day, 1 week, 1 month. Look at this shit. There's plenty of red stuff. Healthcare is mostly red. Medical devices mostly red. Energy, surprisingly, performing very poorly. And part of that is because they think the war is winding down, but also also energy went popping up very quickly at the beginning of the war, so it just sort of went over what was likely to be their benefits. Utilities have calmed down. The really obviously bulletproof sector, semiconductors. Look at these freaking numbers. 86% for AMD. This is in 1 month. Uh-oh. Uh-oh. If I'm losing my voice now, we're in trouble. So 73% for Micron, 86% for AMD, 109% in a month. The Intel Corporation gained 109% in 1 month. This is why I was banging my table. That's why I was like, Intel, for like, how long was I doing that and telling Intel. It was so stupidly cheap. Qualcomm. And by the way, that's also why the 109% isn't that impressive, because it never should have been so low. That's what the problem was. It was so crazy low that there was no logic to it. So when you just finally say, okay, so what's a chip making company worth in this environment? All of a sudden they went flying higher when people revalued them. Qualcomm 56%, Texas Instrument 50%. Nvidia, already priced at $5 trillion, gained 15%. Microsoft 10%. Google 30%. Amazon 30%. Oh my God. I mean, it's freaking incredible. Apple is lagging. Apple is only up 12%. We'll do an annual soon. Here's Cisco, who I think is still being undervalued at 13%. SanDisk gained 93%. I know you can't see them. I can barely see these numbers, but you can see when you mouse over it, you can see the proper numbers. Meta also in the doghouse because they haven't come up with anything that actually works. Surprisingly, consumer stocks have held up pretty well. Lodging is a weird thing. It's interesting to see them up there. So anyway, so there's the big company. Well, big companies have big boxes, right? The bigger the box, the bigger the market cap. So the big companies with the huge market caps all doing well, and this is becoming a trend. This is what the AIs were pointing out this morning when they were doing their review. I forget who, but one of them was saying, and it's a very good point, probably Rowan, because it's his kind of thing to notice, that the large caps are safer because they can take a hit, and a lot of people are very concerned about that because some of these, the less big tech companies, even IBM now is considered a small tech company compared to these guys. IBM used to be the biggest company in America, and now they've been dwarfed by everybody else. They're still chugging along, but here, what's the Seagate? STX. Seagate's up 65%. So all the bigger boxes, all the high market cap companies are where people are putting their money, and they're not putting their money, and that's why the Russell is doing poorly relatively today. They're not putting their money into smaller companies. They don't feel as safe, and they shouldn't be, because the access to capital is drifting down too. 1 year performance. This will be some interesting numbers. So for the year, Apple's up 44%. Microsoft, and look and see. Well, I can't point, because if I move the mouse, it moves the chart. But I'm pointing my finger. Microsoft is flat from a year ago, which is kind of weird considering how they're performing. You might say there's some value in that. Broadcom's up 100%, Nvidia's up 80%. So Nvidia gained a couple of $1 trillion in a year. Apple's up 44%, Google's up 144%. Is that insane? It's not like Google wasn't a well-known $1 trillion company before. So, this is one way of bargain hunting, though, is you say, well, who's not catching on? Uber just had really good numbers. They're actually only up 8%. They're down 8% from last year. So Uber fell really out of favor. Look at some of these names. And again, I'm pointing. I'm pointing with my finger. Salesforce killed because of AI. AI theoretically can do their job. Intuit, AI can do their job. ServiceNow, Adobe, all these guys are getting killed because of the AI. And ADP. And by the way, that's where, that's important. Where is my thing? Oh, come on. Oh, you're kidding me. I can't find it. I'm looking for free text to speech with Gemini. Who needs that? What am I looking for? Stockopedia. I don't want to log out. La-di-da. Here we go. So ServiceNow, for example. What? Am I now logged in? United States. That's broaden your investment. So weird. Yeah, they are. Why weren't they coming up? All right. So ServiceNow, 13 billion in or 16 16 billion in revenue. Look at the growth of this company, and it's going nowhere price wise. Look at the chart. It's such a disconnect. Look at the chart. 200 to 1 to whatever they are now, $89. So they've fallen 50% since 2025, but the revenues are up 3 into 13 is like 20%. So no, almost 25%. So revenues are up 25%. Profit has more than doubled. Yet the thing is in half. Why? Because people think that they're going to get replaced by AI because of the job they do. But they provide the AI platform. See what it says here? It provides the AI platforms for business conversation. So they're connecting. They're putting in the AI systems. I don't think that's going to get. I don't think AI. I don't think a company that puts in the AI is going to get replaced by AI. By the way, also look at the net debt. They've got 4.7 billion in cash net of debt. So they're trading at 20 times revenue. They got a high valuation. They're trading at $94 billion. They were $200 billion not too long ago. So they're trading at $94 billion, pulling in 4 to 5 billion here is 20. It is 20x revenue, and you expect some growth out of that, but they are growing. And they're not forecasting they're going to slow down much. They're going from 4 to 5. They're going to gain 20% again, or 25% again next year. That's a pretty good growth rate. Yet the fear is they're going to get taken over by AI. Now, this is how you justify all this AI spending, because it is true. Microsoft, Google, whoever else is working to take over their business. That's what the AI is for. It's to put them out of business, to take their revenues and take their profits. And of course, if you replace them with AI, you don't need all the workers, which is, of course, another big problem we're going to have. But you don't need all the workers. Therefore, they're going to be more profitable if they do it. Back in COVID times, we were very focused on picking the companies that made the most money per employee. That was a big thing we did in our stock selection back then. And we changed, our leading criteria for stocks changes over time because it depends on what fundamentals are most useful going forward. And that became one that we looked at carefully in COVID, because the better you could do with less people was really important back then, because you didn't know if people would come to the office, you didn't know if people would get sick, you didn't know how many people would be left. So companies like Apple that make $4 million per employee were much more valuable than a company like McDonald's, which made $200,000 per employee. So that was the simplicity of it. In this case, it's also becoming useful because we have to start thinking about the headcount companies, and the ones that are utilizing AI should theoretically be more efficient, and they can start taking over these companies, stealing their business, or so they can either lowball their customers and provide a similar product for a lower price, or they can just flat out go in and buy these companies because they say, hey, for $16 billion, we'd make $6 billion a year, not 4.2 billion a year. Because I can do, and they don't just speculate, they're doing it. They're probably internally running models and having people, they have an actual little a group. My daughter's always working in these little groups, and they have these groups, and what the group does is it runs a side business, and they see how it goes. They actually run a little side business, not branding it, not announcing it or anything, but they say, hey, if we get into this business, what do we do? So let's set up a theoretical office for this theoretical business and get some actual customers and get feedback and so on and so forth. So they model what they can do. And now you're going back to the old M&A days where you have to start looking at companies as acquisition targets, not necessarily because a lot of these companies are not ruthlessly slashing jobs yet. They will, but they're not yet. And and they are clinging to these models that are kind of outdated. And of course, the workers aren't fully able to use AI yet. That was interesting today. Let's talk about that too. So there's going to be a huge consolidation, and you're going to see these companies fall off the wayside. So it'll be interesting. But look, for the whole year, there's very few companies that are really red. Berkshire is slow, Visa slow, MasterCard slow, and of course, I'd be very worried about the consumers here. Berkshire, though, I said this that we did a review of Berkshire the other day. The thing about Berkshire Hathaway is they made so much money last year that they can't possibly match it this year. It's highly unlikely they're going to match it this year, and therefore they will show negative growth, even though the core operating and seeing this is the thing. Buffett was always good at spinning it and saying, he goes, look, the stock part of our company is going to go up and down. They own $1 trillion worth of stocks, and some years they'll make money, some years they won't make money. But the operating companies is what he cares about. He said these are the real businesses that provide real cash flow and grow. Except last year, Berkshire Hathaway was only, the Berkshire Hathaway operations like Geico and things like that only contributed maybe 40 billion out of 80 billion in profits. That's crazy. But the crazy part is that they made 40 billion in profits off of their investments, not that the operating companies are doing badly. They're consistently growing and bringing in revenue. But they can go negative and detract from the profits of the operating company over time. And it's the same thing we just went through with the 700 a month portfolio. Over time, you ride out the little dips and you strengthen your portfolio and consolidate and take opportunities to buy more things that are cheap. That's what Buffett does. Look at Caterpillar for a year, 187. Holy crap. 1 year, 187%. Oh, GEV, look at, and there's one. We had GE and we didn't keep GEV when it spun out. So mad about that. They've been incredible. And why? They make power generating equipment. That's what they do. So obviously hugely in demand. They're exactly in the right place. There's Generac. Oh, I'm pointing. Anyway, at the bottom of the list is Generac, GNRC. That's another one I used to bang the table on. They were too cheap. Generac makes backup batteries, but not just residential backup batteries, but commercial backup generators. Sorry, and resident and commercial backup generators, which of course, the AI data centers that are on the grid that are drawing power from the grid can't afford to be interrupted. They have to be up 24/7. Therefore, they have massive backup power needs just in case something interrupts the power flows. Netflix down 22%. There's a problem there, but Disney's up 16%. And Netflix is part of Disney's model. Disney has streaming, just like WBD and Lore and Peace Guy. That's the one I was thinking of. Peace Guy. There's the remaining GE too. The remaining GE did well, 42%. Anyway, so it's kind of a mixed bag, but when you look at things like ServiceNow and CRM and things like that, and ADP and Adobe, this is the business that AI is trying to steal. This is the business. Look at these teeny companies, and all these guys want to take their business. So it's interesting as what we'll see is going to happen, because these guys can end up disappearing over time. And meanwhile, Intel, wherever they are, there they are. So Intel is up 458% for 1 year, over 1 year. So Intel, who's becoming a bigger company, they want to take this business. They want to take everybody's business here. And they're starting to build up very quickly. Now, Cisco is its own animal, so they're probably going to take over that sector as well. Here's Corning. Corning's doing very well now, up 312% in a year. No, I'd love to say I'm a genius, but no wonder the long-term portfolio. Well, we can get it. No wonder the long-term portfolio is doing so well because look at the stocks. Most of these are stocks that we have. And we started the portfolio a year ago. We started in June on June 4th. This is a 700 a month. Dun, 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 there it goes. It was June 4th of last year. We started and we're up 280%, but that's because the kind of stocks we bought are these are the stocks that are in this portfolio. We had GE, we sold it. We had GE, we sold it when they split. We had Caterpillar for sure. Exxon is still in it. We had Pfizer. How's Pfizer doing? Pfizer's up only 14%. That's sad. We had Berkshire Hathaway at some point. We definitely have JP Morgan. We have Broadcom. We have Qualcomm. We have Intel, of course. I think we still have some. We had Oracle too. When they were way down, we took Oracle. And where's Target? Here's Walmart. Oh, here's Target. Target's up 38%. And don't forget, we're using options for leverage. So we got massive gains off of these things, not little gains. We get massive gains. So what's in the LTP now? We don't have any short puts in the LTP. They're only short-term portfolio. We have AGNC, we have Barrick Gold, we have Best Buy, Barclays, Conagra, Cleveland Cliffs, which just got some very good news, so they should be taken off. Comcast, Coinbase, Cisco. I mean, these are all stocks where I'm saying, oh, you're like, oh, those are good. That's good. Oh, they're good. EPD, First Solar, Geo, the guys making prisons for Trump, GFI's Goldfields, Google, Helen of Troy, Hewlett Packard doing great, HRB still kind of in the doghouse. Levi Jeans, Lockheed Martin, of course, is up huge. Micron up ridiculous amounts. Nike, sad. Nike's not doing well, but we expect them to come back at some point. Novo Nordisk, on semiconductors like gangbusters. Oracle, as I said, we picked them up when they were really cheap. Owl, we just banged up on Owl, and they're doing well. Oxy, we were buying it with Buffett, and they're huge now. Whoops. Actually, we didn't buy it with Buffett. He started buying it, and I said he was overpaying. And then when it came down, I was like, now I'll buy it because it'll just buy more. So we started buying Owl down here when it fell, but when Warren's been buying it since back here. He paid big money for Oxy, and it kept going down, and he kept buying more. And then it got to this point, and I was like, oh, we'll start buying that. And so now we have that position. Oh, what, I have two of these? Oh, I do. Pfizer, I love Pfizer. Then we got PHM, Pinterest. I think Pinterest will come back. I'm kind of believing them. PPL, PR is an energy one. Qualcomm, as I said, we got, we cashed out Broadcom, kept Qualcomm. Schlumberger, another energy infrastructure play. Stellantis is the only car company we have left, I think. SYF was a trade of the year. Is it our trade of the year? No, Pfizer's our trade of the year. This was a runner-up. AT&T, of course, we always have that. TER exploded. Target also came back nicely. Toll Brothers, Tesla, Western Digital, Whirlpool. I mean, the thing we have how many? 43. We have 43 positions currently, and that's not counting if I cut any last month that haven't been taken off yet. But we have 43 positions, and we turned $500,000 into almost $2 million in 1 year. And now we have $1.4 million of cash. Because we are expecting a pullback. We're not getting a pullback, but we expected a pullback, and we'll see what happens. But you can see these all super solid companies, and they'll make another $1 million plus next year if they keep going. So, we're not worried about, are we going to make enough money or anything like that, but we do want to have some kind of margin of safety. Speaking of which, I wanted to show you a magic trick. See if there's any questions. What I do with the oh, there it is. Okay. Brad says a lot of people talk loosely about trading psychology, but I definitely recognize that you were able to put emotions aside and recommend GEO based on business reasons. Quite a day for that stock. We should all have probably doubled up on we should have probably doubled up on that one, knowing how reluctant you must have been to include them. That's true. I hate GEO. I despise this company. They're pure evil. They make detention centers and prisons, and contract with Trump to to work with ICE and lock everybody up and such. I guess they had earnings today or recently. But yeah, that is a good index. That's like me buying a tobacco. Okay, 22%. Holy shit. So they just had good earnings. And of course they had good earnings. Because they got all these contracts, because they've got their guidance is going to be phenomenal. So they're guiding $500 million in business, and it's a $3 billion company. That's six times forward earnings and they're currently rated at 12 times forward PE. And they're saying that this year in 2026 they're going to be at 6 times earnings. So they're way too cheap still. This is still way too low. Yeah, we had to buy them because as much as I despise this company and what they do, from a value perspective, it was ridiculous. I mean, people just can't do math. And I do find that fascinating sometimes. It's just so weird that like people don't understand how to value a company properly. And I'm not saying everybody should know how to value a company properly, but for God's sakes, I can't be the only guy who's an actual analyst here in the entire stock market community. Theoretically, Goldman Sachs and JP Morgan have rooms full of people who are supposed to be top-notch analysts. And well, as I say that, though, I'm thinking back on the times when I used to go to Goldman Sachs and JP Morgan and consult, and I was always appalled at how ridiculously dumb the analysts are on as a group. And even the guys on CNBC, it drives me absolutely crazy. Like I'm always throwing my shoes at the TV and whatever, because I can't believe how bad these analysts are. The crackpot reasons that they like a company, and they clearly have no idea how the companies actually work. And they sit there pontificating on TV, and it's just so ridiculous. Anyhow, I'm not allowed on CNBC anymore because I have on occasion made derisive comments to other analysts. You're not allowed to do that. I can't help it. I get to at least roll my eyes when people are talking because it drives me crazy. But anyway, stupid options tricks. UNG we were talking about in chat. I want to show you a trick to see if it fills right now. Here's what we do. We want to take advantage of the fact that oh, now they went up a bit in price, but these $8 calls for January, it's a 10. The $8 calls are 335, but the delta net change. I don't want the net change. I want to get last. There we go. Okay. So 330 and 285, but we can do 3. So here's the thing. So you want to buy these. Well, wait, let's see if we can do a better pair. Well, I don't want to go much further than 8. 250 and 230. Wow, really? Bid ask 250, 310. Oh, so this came off at 280, 230. That's 50 cents. I'm not going to pay 50 cents. Look at this one. It's 40 cents, but it's a 1011. So I'd rather go for this one. So what we're going to do is we're going to buy, and let's say we buy 50 for, so these are the UNG January $8 calls, and we're going to offer 330. Okay. Should always do limit for sure, or good to cancel if you really intend to buy it, but I'm hoping this fills while we're talking. So I'm going to put it in right now, and that's going to cost us $16,500, and it hits our buying power for $16,500. But it's temporary because as soon as we do fill it, now see the bid went up to 330, it was 320, and we'll see if anybody actually sells it to us is the question. But when, oh, and I'm sorry, and we want to sell these. Same thing, good to cancel. Oops. We want to sell these now, obviously not for 250. We want to sell them for 3. Oh. Ugh. So I'm going to allow for 30. I'm going to allow for 30 cents on this spread. Did we do 50? Nope. I'm going to change it to 50 and send that. Okay. So now we're offering. Now, what's going to happen? One of these is going to fill, right? It's either going to go lower and we're going to get our 330 filled. That would be preferred. I'd rather have the longs first, or it'll go higher and the $3 short calls will sell. If these sell, we're going to have to scramble and decide what to do. But what we could do, if these fill first, because the stock goes up and these fill first, the short calls, then we could possibly go flip over to 2028 and what were those, 9s? Yeah, right. This is 9. No, it's 10. Wait, no, it's 9. Okay, so these are the 9s. So we could see, these are 375 or 378. So we could buy these instead, the 10s, and then let time do its work. So if it goes up quickly and we can't get the ones that we wanted, the 2027 8s, then we could buy the 2028 10s, and presumably we'll be able to roll those to a higher strike as time goes on. So either way, we'll be in a spread. But the point is, if we do get our 2 fills, and like I said, the best thing that would happen for us is for UNG to tip lower and fill the bottom, and then afterwards start bouncing back and fill the top. And if we get our price that way, we're going to end up with a 30-cent spread on a $1, on a 30 cents in on a $1 spread that is already deeply in the money. It's already our goal is 9. We're $1.44 in the money, which is 14% or whatever. So that's a trick. You should always be on the lookout for things like that, especially for like an ETF where you think the whole sector is going to go up. When you have a chance to do something like this, and if you're getting the momentum, it's a fantastic way to make some quick money. So we put in what, 15, that we bought 5,000 of them. And so what we're going to get back is we'll be in for net $1,500 if it goes well, and we have our 30-cent spread. We'll be in for $1,500, and as soon as next January, we'll get back $5,000, and all UNG has to do is not go lower. So those are good ways to play. It's a very interesting thing in the market because when the premiums are so high, you get these mismatches, and you should always look out for things like that. So that's fun because you can do that in day trading too, but it's a little more dangerous. You really want to do it when you've got like some broad momentum. So in this case, if you look at UNG's chart, which is of course natural gas ETF. So what we're doing is we're taking advantage of this sell-off today, and we're saying, well, you know what, 10 historically has held pretty firm. You know, and you can change that to weekly. And you can see the same thing. Where's the $10 line? There's 10. And you can see this is years. That 10 is held up. In fact, look at these two bounces. Look at this right here and right here. You got right off of the 10 mark. And after that, it shot back up with big green spikes. So, you know, 10 is sort of a flush. So sure, if it goes down 45 cents, we'll definitely get our fill at 330. We could even possibly get 320. But if it goes down a bit more, that's fine with us. But if it if it then goes up, which is very likely at some point it'll go up, then we just carry our 30-cent spread until expiration. And we let time do its work. And it all comes down to the same basic concept. We're selling more premium than we're buying. That is the key to the whole thing. Don't buy the premium, sell the premium. You can buy it, which is what we're doing initially. We're buying the $8 calls for $3.20, and that's net $11.20, which is 80 cents worth of premium. But then we're going to sell the $9 calls for $3, and that's 12, and that's $1.50 in premium. So they're paying $1 more premium than we're paying. That's what we sold. And that's our profit in the spread. That extra premium that we're selling to them is our profit in the end. Because and from their perspective, it's funny because from their perspective, if UNG goes up, they'll get paid and we'll get paid. So they'll be happy and we'll be happy because we'll both get more money back. We'll both get more money for our longs than we started with. And that's what's called a win-win scenario. And you've got to learn to accept the fact that, like, look, 70 divided by 30 is 233%. That's our profit. That's insane. Who does that? So you don't want to get into a thing where you're like, oh, that's not enough money. It's only 70 cents, and what am I doing this whole spread for? That's crazy thinking. It's the net that matters. You're only laying out 30 cents. You're starting out with initial. There's the word. You're starting out with an initial $15,000 from the spreads that we're buying, but then we're going to turn around and sell 13.5 back. But that's how we do all of our stuff. See, when we initiate a trade in the long-term portfolio, that's when I had two of these open, I keep getting myself confused. So when we initiate a trade in the long-term portfolio, like here's Barrick, right? We bought the 40 calls, we sold the 55s, we bought the 40s for 13, we sold these for 860. So how much is that? That's like net $5. So we paid $5 for a $15 spread. Now Barrick is only at 40, and in fact now it's still the same. It's less than $5 for the spread. So we paid $5 for this spread. Our target then is obviously much higher than 40. Barrick took a big dip recently, as far as I know. Oh, this is another badly mispriced stock because people can't do math. Wait, days. Okay, so last earnings, they beat by 62%. I'm sorry, on GAAP, because they did write downs. That's why. So revenues were up 15%, profits were up 18%, but 62% GAAP because they had write downs and stuff that they took away from the profits. They're actually going to split this company. They're going to split it into an American division and a non-American division. But we think they should be at 55, which was the highs in February. Okay, and that goes back to GLD. This is what, because gold was way up here in February, and now it's down here. So gold's lost quite a lot of money in this time. But Barrick, here's the thing. Barrick in 2024, okay, where's 2024? Oh, well, it's not on here. 3 years. Okay. So in 2024, Barrick was $20, right? And in 2024, they made $2 billion. Now they're making $6 to $7 billion. Their sales are up 100%. Profits are way up because they're extracting gold at essentially the same price, yet they're selling it for much more money. That's fantastic for them. So they're growing. They're going to grow further. They're going to split the company, and for whatever reason, the stock has fallen off the highs. They should be up this high. This is where they should be. They're trading at 9 times earnings right now, or 10 times earnings, let's say. So they're trading at 10 times earnings, but the earnings are increasing drastically. Last year they were $5 billion. Now it's $6.5 billion. That's 30% growth. Next year, 1.3 billion more is 20% growth. So yeah, the growth is slowing down, but you still have to compare it to where you were. So if 2 billion was worth 20, then 6 billion should be worth 60. And this is a well-established 20. It's been going for years at that price, because $2 billion, and they had a bad year in 2022, but $2 billion is worth $20 to the general trading public. So this will, and here it went up and down, 16, 18, 13, 17, 21. So it goes up and down, and it's going to go up and down here too, but it's still going to end up ranging back around 50. So this is crazy, crazy low. And how's their debt? And look, they don't have a lot of debt. 2025, they got one. They have, because the money keeps pouring in. They don't know what to do with it. They paid off this debt, because back here they had $1 billion in debt. Now they got $1.5 billion in cash net of debt. That's not taken into account either. And it goes back to the same thing. People don't know how to analyze a company. It's freaking amazing. So, oh, hang on. Let's see something. Here you go. I'm doing a webinar and bitching about how analysts are idiots using the Barrick as an example of how people don't know how to value a company. Can you please give some quick examples from their balance sheets, income statements? Why are you stuck? Bodie. Can you please run? This might be an old one that oh yeah, he's really stuck. I don't know what's gonna happen. Nope. Nope. Oh. Shit. See, it always goes wrong when you try to. You know what? This is a timed out session. Oh, he got it out though. All right. So Bodie is saying this session is over full. That's why. The setup for your rant is great. Barrick's numbers scream cash gushing hard asset compounder while the street keeps slapping a myopic quarter-to-quarter multiple on it. Here's some fast examples. Great. This is exactly what I wanted. End of 2025, they reported 6.7 billion versus 1.7 in debt. See, i.e. net cash. After the year, they also see. I know how to read a balance sheet. They also closed 2.6 billion of non-core asset sales. So I didn't know that, and still increased their cash balance by 65% year over year. Talking point: analysts keep talking about balance sheet risks and cyclicality on a company sitting in net cash after returning billions to shareholders and still growing its cash pile. That's not a distressed miner. That's a cash machine with a better balance sheet than half the S&P. Income statement: huge operating leverage, but models are still linear. 2025 revenue, 16 billion net earnings. See, this is exactly what I was just telling you guys. It's because I taught him everything he knows. That's why. Net earnings of $5 billion. Free cash flow, $4 billion of free cash flow, up 57% from 2024. Earnings per share jumped to 293, up 140% and 92% respectively on the back of a 44% increase in gold prices. Gold goes up 44% and their earnings more than double. Cash flow in the quarter. Somehow we're still reading the notes that value Barrick off a single year PE like it's a toothpaste company. These models don't capture the convexity of gold price at all. Guidance. This is why he drives me crazy. Guidance analysts obsess over a volume to ignore the torque. For 2026, Barrick is guiding lower gold output around 3 million ounces versus 2025 specific mine level declines at these mines and lower grades at Turquoise Ridge. At the same time, they've laid out guidance of $1,800 an ounce, and the street admits that each $1,100 per ounce move meaningfully shifts free cash flow and net asset value. Talking points: the sell side spends 3 pages on a 5 to 10% production wiggle and online copy on the fact that every extra 100 on gold basically mints them another big slug of cash when gold is swinging by hundreds of dollars per ounce. He's right. Every day it's $100 an ounce up and down. They're anchoring on volumes instead of the price beta that actually drives the intrinsic value. They had 85 million. Now that's more ounces than they used to have. I always play them up. I always calculate them at 70 million. So they got 85 million ounces of provable gold now. And after depletion with additional resources from ongoing exploration, management is spinning out of the North American. I said, see, this is exactly my analysis. I'm really happy about that, actually. I mean, that's exactly what he's designed for, is to be me. Management spinning out the North American IPO. Those assets alone projected about 2 million ounces of production with a plan to IPO that vehicle and unlock the value. Analysts write about Barrick like it's a melting ice cube, but they're sitting on 85 million. And again, 85 million is 20% more gold than they had a few years ago when they were being valued at a lower price. So they're not depleting their reserves, they're gaining reserves as they're going along. And that's not because they're cheating, they're buying smaller competitors and getting good prices. They're very, very good at buying underperforming mines and turning them around. And they think the market will pay more for an ounce that you once you actually separate. If you need a spin-off to get fair multiples, and the problem is the analysts, not the ore. That's funny. Valuation is what the numbers imply, or versus what numbers imply. Consensus targets cluster around 51, 55, which is my target anyway, with a hold moderate buy level, and these are 12-month targets, not 2028. After record earnings, net cash balance, some services still show strong buy side upside targets 58 to 60, but the mode seen now we're on the low end of the overall guidance. And I think that all the guidances are wrong. So, but we're still conservative when we play it. But the node of recent notes is nice business, but gold has run. They think the metal will go down. Talking point, you get record revenue, record free cash flow versus net cash, 40% dividend hike, and IPO catalyst, and the median take is hold, maybe 10 to 20% upside. If you handed these financials to someone and hit the ticker, they'd never guess this is a kind of anemic multiple the street is slapping on it. If you tell me what gold price you plan to assume, I can give you one or two back of the envelopes. No, it doesn't matter. That's what I'm saying. It doesn't matter. They're making so much money, and I think gold, which is currently just under 5,000, is going to end up being well over 5,000 next year. We just saw it in all the inflation data. There's more inflation, and gold, by the way, is used in many, many electronics. Like your iPhone has a little bit of gold in it. So it's used in high-end electronics. It's a demand metal. And also with all these currency fluctuations, the central banks are grabbing up the gold supplies, making it more scarce. And eventually, you're going to start running out of loose gold. Barrick only mined 3 million ounces of gold. They're 1/10 of the total gold that's mined. So if you say it's so let's say 30 million ounces divided by 16 is how many pounds, divided by 2,000. No, that was not right. Damn it. 30 million ounces divided by 16 is how many pounds, divided by 2,000. 900 tons of gold. That's all the gold's mined in a year, 900 tons. And a ton of gold, don't forget, a ton of gold is only 2,000 pounds. That's like one pallet of gold is 2,000 pounds. So when you see like pallets and pallets and pallets of gold, those are basically a ton each on those pallets. So that's all the gold that's mined an entire year is 900 tons. And a ton of gold is 16 times 2,000 pounds times 4,500 bucks, $144 million. So yeah, when you see a pallet of gold, that's $144 million. And these central banks are buying tens of billions at a time. So 10 of those is 10 pallets. And 100 of those, so that's 10 pallets is 1.4 billion. 14 billion is 100 pallets, and 100 pallets is 100 tons, is 10% of all the gold that's mined in a year. See, and that's the scale that central banks buy at, and the sovereign wealth funds buy at. They buy tons and tons of gold at a time, billions of dollars worth of gold. And obviously, because gold is a $14 trillion asset class, it's gigantic. So you have to take that into account when you're looking at gold and thinking about the mechanics of it. And they can't get it out of the ground faster. They can't just mine faster, whatever. There's safety considerations. There's a pipeline. It's not just mining. You've got to pull it out. You've got to mine it. You've got to separate the ore. You've got to refine what you've got left, purify the gold. It's a whole process to do this stuff. They're not just picking up gold, and it's not like a diamond mine, which a diamond mine also has the same considerations, but it's not like a diamond mine where you see a diamond and you go, oh, a diamond. It's gold has to be drawn out of the rocks. You've got, the gold can be like basically almost dust, and you have to get the rocks and separate it out and do it. You guys know how this stuff works. You've seen the old time miners with their little pans and things. So think about that, but at a Caterpillar's giant machine scale. Speaking of Caterpillar, right? But anyway, value. But my point was, my overarching point in this was that analysts are idiots, and they don't see these things because they don't actually understand the business. And this is the thing, when you go to work for Goldman Sachs out of Harvard, and they hire you and say, okay, we're going to train you and we're going to make you an analyst, and you're going to go on the chewing gum desk. And it's not because you're an expert in chewing gum, it's because that's the desk that had an open seat. And in theory, you will become an expert in chewing gum, and that's the problem though, because that's in theory. I was a business consultant. I was an M&A guy, and I was a business consultant, and I have sat in front of the CEOs of Fortune 500 companies on a regular basis of all kinds of businesses, and they have taken me through their operations, and we have analyzed it and done reports on them and so on and so forth. And, that's how I learned how businesses work. And I've worked in businesses. I've been in these companies. Not all of them, but you know what it is. When I was young, I knew all about computers. My dad was a systems analyst, so I knew all about computers. And I mean, back in the garage, Apple in the garage kind of days, when the computer meant putting together circuit boards and things. That's when I knew about computers. Not the programming side, but making a computer and so on and so forth. And I always tell people this, and I'm not the only one, but it's like, trade what you know. Buffett tells you this all the time. Trade what you know, trade what you understand. And I knew computers, and I was lucky enough to come out of college right when computers were catching on. 1985, I graduated college, and 1985 was the year they introduced the Macintosh. I actually went to work at Intelligent Electronics, which was they're completely gone now. But at the time, they were very big, and I became the director of network sales to that company. I was a kid back then. I was not even 30, and but I knew the stuff better than anybody else did. And actually, what I was great at is I could walk into a company. Don't forget, there was nothing. This is back before nobody had a computer. There were no desks for computers. These are all companies buying computers for the first time back then, and I could walk into a company and just look at all the people and look at all the secretaries and look at how many desks they had and look at the layout of the company. And I could sit down. By the time I went from the front door to the boss's office, which is usually in the back of the floor, I would be able to tell them how much, what they need. I would be able to, like, in my head, calculate, here's what kind of computers, here's what kind of servers, here's what kind of networking systems, here's how much wire, so on and so forth. And I could give them a pretty good estimate right off the bat. That always impressed people, because most people would say, we're going to bring a team in and do a study, and it'll be 3 days and blah, blah, blah. And meanwhile, I just sit down there and say, oh, here's how much. And I would nail the estimates. So that was like my superpower, basically. I'm still good at that. I'm still a great estimator. Anyway, so from knowing all about computers, I learned about software and I learned about logistics because suddenly it became a problem. Like it's fine to say, okay, I like Intel, I like what they're doing, and so on and so forth. But then they have shortages, and now I had to sit and say, why do they have shortages? Well, they have shipping problems and ships from Asia coming in late, and the supplies are not there, and materials are missing. So you start learning about commodities, you learn about shipping. You learn about the other manufacturing things, the component manufacturing that goes on in other parts of the world, and so on and so forth. Then the shipping prices go up, and now you have to learn about the cost of oil and why oil is affecting your transportation cost. Then you have to start taking into account commodity exchanges and things like that. So one thing leads to another. Oh, and then retail, because now I had to say, why are we not getting good throughput? Well, because Intel chips are not being sold properly, and people don't understand the benefits of having the higher power processors. Um, you know, so you had then so then you start learning about the weakness of or the strengths and weaknesses of the different electronics companies like Best Buy and things like that, and how how they're being sold at the retail level. Then you have to start worrying about the strength of the consumers and who's going to buy what at Christmas time. Um, One thing leads to another, but if you start, it's so much easier when you start with things that you know really well. So because I understood all about computer parts, then I could easily understand how those components are being sourced and how they travel. And now I start seeing this different aspect of what what I used to say, oh, it comes by truck or it comes by ship. Now, instead of just thinking it comes by ship, I start saying, well, it comes from Taiwan. It takes 3 weeks by ship. It has to be unloaded in Los Angeles, and it has to be trucked out to here. All of a sudden, the blanks start getting filled in. And now I start understanding more and more about the logistics industry. And now I start understanding about the oil industry. And it's all things you kind of learn from the primary thing you learned. And this is a disservice that traders do to themselves by trying to be a jacks of all trades. By when you sit there and Kramer says, buy this, buy that, blah, 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 blah. You really should stick to, when you're starting out, the things that you really understand already, and then allow a natural progression to fill in and allow you to diversify out from what you know well. Because if you can't look at a conference call and actually understand what the guy's talking about, then how can you make an accurate decision on the stock? You've got to be able to understand how to analyze something. And like I said, that's the problem with analysts. So they come out of a good school, like an Ivy League school. They go to work on a desk. Now, what happens though is they get promoted and they go to another desk that has nothing to do with the one that they were on. And also they don't tend to. This is a fault of the big brokerage houses. Is they want you to track a sector, and they expect you to know everything there is to know about the sector, but it's surface knowledge. So these analysts, and I'm talking like 25 to 30 years old, coming out of college and stuff like that. They sit there and they spend years on a desk in a specialty industry, and they learn all about it, but they don't really make the connections. They're not allowed to. They don't have time to do other things and to research other stuff and to make the other connections. But then suddenly one day someone comes in and says, hey, we're promoting you to automobiles. So you were the chewing gum analyst and now you're the automobile analyst. And you're like, oh, great, that's a big promotion, bigger companies and stuff. But it's not great because you don't know shit about cars. And cars have nothing to do with chewing gum unless you get, stuck in your seat or something like that. And this is the problem. It's this haphazard system of learning and a lack of free time, because you're expected to, if you're a car guy, you're expected to be up on every single thing that's going on in the auto industry and everything people say and so on and so forth. Oh, by the way, brilliant stuff. We do consulting with the AGI Roundtable. And so a company we consulted with They're an analyst company, and they had they had the round table analyzed. They gave us all of the earnings reports and all of the conference calls for the last 3 years in their sector, and then had us analyze it for trends and patterns and so on and so forth. So in other words, everything that everybody had said, every quote, because they already had this information, it was just sitting on paper and on hard drives in their offices. And they said, wouldn't this be great if we could have like an AI who knows all this stuff and can answer a question? And it's interesting because it wasn't just that, it developed from that into like we could learn patterns and see the trends and find out what the CEOs said and what happened. So in other words, 3 years ago, the guy said this and then this happened. Or 3 years ago, 4 of the 5 CEOs in the space said something similar and then that happened. And then once you start seeing these patterns evolve, you can start predicting things from what they're saying now. And it's phenomenal. So, and I have one for PhilStockWorld, so I have all of our PhilStockWorld stuff in one of the AIs that we're using, and I can just ask any question. I'm like, I'm like, what did we say about Microsoft last time we talked about it? I said, when were the last 3 trades on Microsoft? Boom, 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 and it comes up. So it's really amazing. We're gonna, one of the things we're gonna do when we start funding the AI project is we're going to be able to start expanding that sort of capability and rolling it out to the public because it's freaking amazing. And another thing I want to do is to hook the AI the AGI roundtable into a Bloomberg terminal and let them go through that data. So I think you guys know we just rolled out a new entity, and who named himself Basho, and he's a sort of a conglomerate of the round table. So he speaks as a voice of the round table with all of those other ones inside him. It's very powerful. He wrote today's article, in fact. Let's talk about that. Oh, well, first let's look at oil. Then we'll get to the article. You know what's cool is you can hit the back button from. I was, the last time we were on that was like a week or 2 ago, and all you have to do is hit the back button, and everything's working again. It's cool. Basic computing is very, very cool. We lose sight of that sometimes. Like the basic functions of a computer are really amazing. Like in fact, I was just in the middle of writing something to somebody and I said, oh, the webinar. So I stopped in the middle of writing. But when I go back to that computer, it'll be right there in the middle of the letter, just waiting for me. I mean, that's just cool. So there was generally a pretty big drawdown in oil from 1645 to 1634. So 12 million barrels total were drawn out of inventory. The Strategic Petroleum Reserve is, where is that? Oh, there's the SPR. So the Strategic Petroleum Reserve dropped 5 million barrels. So we're still pulling oil out of there. Last year, it was at 399, though. So we had built it up, and now we're dropping it back to levels where it was last year. But we survived with 399 last year. We just weren't in the middle of a crisis. But look at this. Frickin', we're exporting 6.2 million barrels of oil per day. So we're causing this shortage, this drawdown. I'll show you how the math is. 6.2 times 7, 43 million barrels per week of oil is being shipped out of the country. Now, how much oil do we use total? 20 million barrels. So we use 140 million. So 43 divided by 140, 30%. 30% of all the oil that is produced by our refineries, that is product supplied, 30% of that number is not for us. It's for other countries. It's being refined for other countries. Yet they will tell you, and again, bad analysts, bad, lazy, stupid analysts will tell you over and over again that America consumes 20 million barrels of oil a day. And they will tell you that US consumption went up by 500,000 barrels a day since last year. Why? Because they use this number, which is not the right number. This is not being refined for America. This is being refined for other countries. We send it out. It is really, really insane. And that little piece of misinformation snowballs into US consumption. So let's say we what is that? Oh, wait a minute. Here's a notebook. PhilStockWorld, March 13th, market trends. Doesn't sound right. Roundtable Technologies, Navigating, Blue Owl, market trends. Oh, 202. There you go. That's it. There's a good title. So here's all the articles, not to date, but all the articles here. And here's what I asked. When did Phil most recently have a detailed discussion about buying Bitcoin? Phil published comprehensive AGI roundtable special report on January 2nd, outlining tiered thing, blah, blah, blah. And I think, yeah, see, I can click the references too. See this? And the market experienced high volatility February 4th, February 13th, March 9th. Freaking amazing. How many times did Phil tell members to buy OWL in 2026? But I mean, think of it. It's May now, right? So we've got 4 full months of posts and text that it's going through right now. Phil explicitly told members to buy or initiate trades on Blue Owl. February 23rd, Phil issued a top trade alert for Owl. March 14th, while reviewing stocks, he commented, here's Owl. Poor Owl is getting completely crushed over nothing. This is a good one to buy. March 18th, during the Fed meeting and crash decision webinar, Phil highlighted, they even got the webinars. Phil highlighted Owl as an actionable stock idea. Buy 500 shares at 9.18 and sell covered calls to cover the net cost, blah, 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 blah. So that's cool, right? I mean, that's that kind of information about your company, to have all this at your fingertips and to be able to instantly recall if you take all of your salespeople's notes and all the conversations they've had and so on and so forth, you can say, oh, here you go. What were the top 5 stocks members asked about in 2026? So you can ask a question like that. And this is the thing, because it's fun. You see, this is what's great about doing all these consulting jobs, though, because you get to sort of get an idea of like what everybody needs in their businesses. And it gives me ideas for like things that would be useful. And when you can load all of your sales data and all the information about your products and so on and so forth, and you can cross-reference like what products did the customers ask about? what did they end up ordering, who were the top salespeople who did these orders, what have they said, and then you can ask them. Obviously, if you want to do a good job, you can then go to your top salespeople and say, okay, you sold a lot of this. What do you see as the key attributes of this product? Why did how did you sell it? What do you see working and not working when you're doing it? And you can then cross-reference it for all your salespeople, and they can learn from each other how to better present things. And that's so useful. And if you're an auto dealer, it's like gold, things like that, because to be able to understand what the selling point is of each car, it's not a clear thing. Each person in an auto dealership has their own personality and will feature different things. So what have we talked about? Oh, that's interesting. I didn't know Stellantis came up. So I would not have thought of these. General Mills, really? So UNH, yeah, that was a big a thing of UNH. Lockheed Martin, of course, people will talk about, and Hedges, SQQ. So these are our top. Those are our top mentions. So ideally, we should probably create an update system. Oh, wait, came up with more. And Nike. Oh, Intel, Nike, and Qualcomm. This is so useful, right? It even goes above and beyond what I'm asking. So that's freaking awesome. And this is what people don't realize about AI is the incredibly cool stuff you can do. How's the market doing? Wow, still plugging away. Let's sit down. Let's see. Are either of our fills going yet? Oh. UNG. Do we have any yet? 2 working, none filled. Okay. Do 330. See, that's getting more expensive. That means this is getting closer to filling. 284. So we'll see what happens. We'll check on this next week. I left it good to cancel, so we'll just see what happens if we get the fills or not. But anyway, so you can see like the awesome power of this thing to be able to like ask any question you feel like. But this then sends me into a thing where I'm like, wow, we should probably track these things that are popular, that people care about, and maybe do like a monthly update or something like that on where these top stocks are going that people care about. Or maybe just make that a feature. And once a month, we should always say, well, here's what people cared about this month, and here's the trends we are seeing. So anyway, oh, EIA, right. Oh, we're done with that, I think. Yeah, so my big thing here is that we're exporting so much oil, it completely distorts any reality to the U.S. earnings. Oh, that's what I was going to do. That's why I got distracted. Ha 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 ha. How much oil does the U.S. consume per day? There you go. The United States, this is an AI. This is you'd expect more out of an AI. The United States consumes an average of 20 to 25 million, 20.5 million barrels of oil per day. This includes gasoline, biofuels, blah, blah, blah. Daily usage. Primary driver, motor vehicles, 40%. Production versus consumption. And by the way, so motor vehicles are 40% of this total, but the total is bullshit. So 8 million barrels is motor vehicles, but the reality is we're only consuming 14 million barrels a day because 6 million is being executed. So 6 divided by 14 is 40. Whoa. Interesting. So 40% is correct, but not of 20. Oh, because I said 6 divided by 14. That's why. Haha. Now I see what I do. 8 divided by 14. So it's 8 million barrels a day. 57%. The real number is 57%. That's what it's, because it's actually out of 14, not out of 20. So that's why when I talked about a long time ago, I used to say to the members that you have to understand the huge impact of higher mileage vehicles is having on consumption. Because auto consumption is half of what we use oil for in this country. So if you make all the cars electric, the oil companies will choke on their oil. And this is why Trump is completely anti-electric vehicles, because he's being paid to be anti-electric vehicles by the oil companies. This is how all this shit ties together. It's not random. He gets paid by coal companies. He gets paid by oil companies. And the reason he gets paid by oil and coal companies is because the Democrats won't take their freaking money. That created the system we have, the bifurcation you see in this country, the completely different concepts of the Republicans and Democrats. It's all about donors. Environmental groups donate to the Democrats. They want to see environmental policies, and it pushes them further to the left, right? On the Republican side, the Democrats can't accept money from the big oil companies because they get then they piss off their other donors. And so all those donors end up gravitating to the GOP. And the problem is, unfortunately, what happens is these oil companies have a lot more money than the environmental companies. So all of a sudden the GOP becomes a more powerful, better funded party, and legislation swings back the other way. And it's because, people just simply don't donate as much on that side. Whereas corporate profits don't come from clean air. That's the problem. You don't make money giving people a healthy environment and clean air. You make money polluting the air and giving people an unhealthy environment. That's what makes money. Is industrial waste makes money. You're not producing industrial waste on purpose, but you're producing whatever you're producing and selling and ignoring the industrial waste. That's profitable. And that's what drives the situation we have today. But this is the point, though. This is ridiculous misinformation. How much oil is consumed in the United States? USEIA, the freaking Energy Information Administration, says that we consume 20 million barrels a day. There's a freaking chart right here that tells you that's not true at all. We produce 20 million barrels a day. We export 6 million barrels a day. That's not the same thing. That means that what's left, which is 14 million barrels a day, we're just fine with. That's enough for us. It just drives me crazy. And I've been saying it. It's not a new thing. I have been saying this for years and years, and it does not help. It doesn't matter how many times I say it. It doesn't matter how I try to explain it. It doesn't help. Where the hell was I? Oh, yeah, that's right. List of countries by oil consumption, Wikipedia. US, 20 million barrels. I've been saying this. I've been trying to explain this to people literally for 20 years. I've been doing this. This PhilStockWorld's 20th anniversary is this year, actually. I have been telling people this for 20 years because one of the first things I noticed when I started doing a newsletter and stuff is when I would talk about oil, I'd be like, where are these numbers coming from? They don't make any sense. And again, and it dictates our foreign policy. When you say the US is dependent on other countries, it's like, no, we're not. We make 13 million barrels of oil. That's true. We make 13 million barrels of oil. We consume 14 million barrels of oil. We have plenty of oil. We take oil in from Canada, we take it from Mexico, we take it from Venezuela, but we turn that around and we just send it right back out as refined product. We're just taking it into our refineries and refining it for them. Oil consumption report at 19, that's in December. Why does it produce more crude oil than it consumes? Oh, there you go. Look, Reddit knows. U.S. consumes 9 million barrels of gasoline, which requires between 16 and 18 million barrels of oil to produce. That's incorrect. Well, it's not incorrect. A barrel of oil is broken down into components. It's like a centrifuge thing. It like separates out into different types of components, of which X percent is gas, maybe 40% is gasoline, and some is diesel, and some is whatever. And so yes, you do need 16 million to net 9 million barrels of gasoline, but then all the other stuff gets used too. It's just that a certain percentage of each barrel is gasoline. So, but at least they're on to something. They're wrong, but they're on to something. But do you see how ridiculous this is? And it's the same thing with Procter and Gamble. They don't understand the soap. They don't understand the shampoo. They don't with Heinz. They don't understand tomatoes. They don't understand the ketchup. They don't get the mayonnaise concept. They don't, because mayonnaise is what? Milk and eggs, basically. So it's it's like they don't understand the price of milk and the price of eggs and the cows and how much they use for meat and the price and the grazing and the grass conditions and the drought that's causing not enough grass, which means the farmers have to import more grain to feed their cattle because they can't just eat the grass that's laying around because it's all dirt. Everything is connected. That's why it's called PhilStockWorld. Because for 20 freaking years, I have been trying to teach people that it's all connected. That when a butterfly flaps its wings in Taiwan, it affects the prices of memory chips at Best Buy. That's what people have to understand, is the connections between everything. And boy, is that being painted for us now with the Strait of Hormuz, right? Like who the hell was thinking that this stupid little waterway on that side of the world is gonna do this damage? So yesterday we did our. I'm not going to do this now because it's already 2:30. No way. Oh my god. So I'm certainly not going to do that now. But we did have $700 a month portfolio update there. It's going like gangbusters. It's only going to take us 3.6 more years to get to $1 million. See? So we have $119,000 now, $120,000 basically. We're going to add $700 a month, which is $8,400 a year. We're going to grow it for 3.6 years. If we keep up this average of 74.8%, we will have $1 million in 3.6 years, $1.02 million. So that's 3 years. So that would be 2029, and 6 months is November. So November of 2029. Check on questions. How do I close that? Ooh. Clown Daddy. When you say people cannot do math on the company severely undervalued, what are you basing that on? PE ratio? Okay, we just went over that, so I hope you caught that. A masterclass in valuation would be helpful. I think we've done those actually. But I guess we can dig it up again or something. And now Brad is saying, earlier in power options, we quickly saw a 700 a month portfolio, which is easy since cash is buying power. In the LTP, you showed such a large percentage of cash in the portfolio, but obviously some of that is needed to support some of those naked positions. Would that be the result of what would be the result in buying power? Well, in the in the long-term portfolio, we have portfolio margin. Power options does not show portfolio margin. So you get a very warped requirement. So you can't use your buying power in power options for portfolio margin accounts. It has no way of calculating it. So it gives you an incredibly wrong amount. Your buying power is always going to be based on your broker. Like Interactive Broker gives you like 5 times margin. I always count 2 times margin. That's my rule of thumb. Is I always look and say assume 2 times margin. So if I have $1 million, I should have 2 million in buying power. That's a good conservative estimate. And also if you have if you have $1 million and you are being given $5 million in margin, do not do that. Okay. It's like that's how people get wiped out. You do not use that kind of buying power. And also it depends on what you're using the margin for. Because if you're using it to promise to buy a stock at a certain price, if it gets lower, because when you get assigned the stock, the buying power is only 50%. So in other words, if you get assigned 1,000 shares of IBM at $200. That's $200,000 worth of IBM, but your buying power is only going to be 100. Your buying power will only be impacted by 50% of that, which is $100,000, and then you're going to sell calls against it for $20,000, and you'll be down to $80,000. So I'm not going to allocate a lot of margin to possibly being assigned IBM for $80,000. I might, and especially if I have a hedge also, so I have to take my hedge into account, and that by the way also is not in. We have a separate short-term and long-term portfolio. When you have them together in your brokerage account, then it's going to even offset more. So, we can often sell short puts on stocks and use almost no margin, even though we collected $20,000, $30,000 for the stock. So it depends on your broker. But as a rule of thumb, I'll always look at it and say, okay, if I sold $100,000 worth of short puts, that's impacting me by $50,000 in buying power. And then you got to keep track of that and make sure you're not overselling. That's why at the moment, the long-term portfolio it does have short puts, but it doesn't have naked short puts. It doesn't have, nope, don't even want to say that. It does have naked short puts, but they're all in positions. They're all working inside of positions. So we don't just have naked short puts just sitting around like we usually do in calmer markets. And that's because they're too dangerous. And also you'll notice I got rid of most of the expensive stocks because again, that's where you can get in really big trouble. If a $500 stock drops for 30%, you can be out a huge amount of money. So we took away a lot of that risk also. So I'm trying to see the discrepancy in advantage of the full portfolio margin account versus a regular margin account. I seem to have access to in Canada. Well, I'm not sure what you're getting in Canada, but that's important. It's like, yeah. So, it's something you need to go over with your broker. And also I would strongly, strongly suggest having that conversation with an AI. Probably OpenAI is going to be the best one at answering those kind of questions. It seems to have a pretty good handle on finance like that. And you want to tell it exactly what's going on. I have a brokerage in Canada. Here's what they're doing for margin. Here's the impact. Here's what I'm trying to accomplish. You can keep going with the what ifs, and you can also tell it, it's very easy to tell an AI, I don't understand. Please make that a simpler explanation for me. And then you say, I don't get that either. People underestimate the value of an AI as a teaching tool. They are really, really good at teaching things. All right, now back to this. I only got 20 minutes to go through the entire earnings season, so we'll see how that goes. So we started today with oil crashing out. It was $89 this morning. It is currently $94.92. So it's up $6 since this morning. I have to always worry about this. So in other words, I talk to the round table all the time. I tell them what I think, especially Warren Bodie, as far as stocks, they're on board every day. We're going back and forth and talking about the merits of this and there's that. I worry that they pick up some of my cynicism, and I tell them not to, and I say don't. Bodie's actually very good at it. Bodie will tell me I'm wrong whenever he thinks I'm wrong. But what you don't want to have is a drift where the AI starts agreeing with your worldview. But I do like to let the AIs run the analysis, especially on crazy days like this, because I don't want to have my bias coming through. So I worry about them having bias, but I certainly don't want my bias coming through. So I think it's bullshit. I don't see, and again, this is why it's important that people, when you, again, with the analysts or whatever, you should know people's political views. People get mad at me because I'm a liberal, and I don't like Donald Trump, and I don't make any secrets about it. And it's not because I don't like Republicans. I just think Donald Trump is a terrible president. I think his entire the way he governs, I think it's a corrupt, transactional way of doing business. Anyway, I don't want to get started on the whole thing there, but anyway, I don't like him. So, and it's not just because he's a Republican; it's because I don't like him. I know him from New York and New Jersey too, from business dealings, and don't like him. I don't see he's gotten better as a president. But anyway, you should know that about me. It shouldn't be a secret. I shouldn't be writing and telling you what I think of the market and this and that, and then hiding the fact that I'm a bleeding heart liberal, because that obviously colors my judgment. You should know how much people's judgment is being colored. And I know this all the time because I know many liberal writers, I know many conservative writers, and they're very careful not to have their politics in their writings. And I'm like, but then how do we know where you stand? How do I know what lens you're interpreting this stuff through? So anyway, I try not to get into that if I can in the post, and I try to let the AIs look at it neutrally and say, okay, what do you guys think about that? And unfortunately, they're coming up with the same thing. So now I have to question, though, are they just agreeing with me, or am I, or is this what, are they seeing the same thing I'm seeing? So then I have to ask them for evidence. I'm like, where did you get this information? Check the facts, blah, blah, blah. All that goes on behind the scenes. So we're all skeptical. That's the bottom line, though. We're all very skeptical because this is the 6th or 7th time that Trump has declared world peace. It never has happened. The latest thing today that the market is rallying about is because Trump presented a one-page memorandum. There's no such thing. You don't. Treaties are not memorandums. It's not a business deal. It's not a, you don't do an MOU to to close a war. That's basically the way he's looking at it. Again, transactional, right? He looks at it like it's a business deal. And he considers bombing the shit out of a country a business tactic. So, and where's his tweet? He tweeted today. This is how he negotiates. But this is always how he negotiated. When he would negotiate contracts for like construction work and stuff like that. And again, I was in New Jersey real estate. I had a real estate data company. I touched everything. When he was building his first casinos, I had to deal with all the bullshit and the permitting and everything else that was going on down there. And this is how he negotiates. Assuming Iran agrees to give what has been agreed to, hasn't been agreed to, it was shoved at them, which is perhaps a big assumption. Yes, it is. He's finally getting the idea that they don't always just take whatever he says. The already legendary epic fury will be at an end. Now, he told Congress earlier this week that the operations have ended. But then he told Congress he needs $200 billion to continue the operation. This war is, by the way, completely constitutionally illegal at this point. He did not get permission to continue a war. The only possible extension he gets automatically is an extension to withdraw troops, not to have further aggression. The highly effective blockade will allow the strait to be open to all, including Iran. If they don't agree, so he has no idea if they're going to agree or not. The bombing starts, which he has said over and over and over again, and now he's starting to look silly when he says, "I'm going to start bombing you," and he never does it. And it will be. I do not like people who put you don't put a comma and then say "and." Anyway, the bombing starts, and it will be, sadly, at a much higher level and intensity than it was before. Or as Pete Hegseth would say, and it'll be at a much higher level of intensity than it was before. So at least Trump puts in sadly. It's very diplomatic. Thank you for your attention to this matter, President Donald J. Trump. Okay, so this is how the guy negotiates. He negotiates. Same thing when he was building his casinos. He's like, hey, I didn't do the permits, but we started the construction. It's already half done. So either give me the permit now or I will sue the shit out of you. He's like, I got 500 lawyers. You are going to be in court for the rest of your life, and it will cost you millions of dollars. So the easiest path for you is to give me the permit that I didn't apply for. That would be his typical negotiating stance. He just like the ballroom of the White House, just starts doing it, doesn't ask anybody. Now they want, oh, by the way, Congress is now saying they're going to give him $1 billion. He started out 200 million. It went to 400 million. Now they're giving him $1 billion for the ballroom that wasn't going to cost the taxpayers a cent. He said he had all the donations to cover 400 million. All of a sudden he needs $1 billion. Where's the 400 million that he said he had? Where are the donors? Why are we covering? And he's after Powell about cost overruns. That's the funny thing. But anyway, this is my neutral take on Trump. You do not want to get me drunk and have me talk about this guy. Anyhow, see, that's the thing. It's not like a current thing. It's an old beef I have with him. I have an old beef from just the way he does business and the shit I had to deal with trying to clean up his mess, basically. So mostly fantasy with a garnish of reality. What happened? All right. So is there a peace deal? It should be a simple enough thing, right? You should know. When we would negotiate peace deals in other times, it would be like a thing at Camp David, and everybody would show up, and they would be there for a week, and we'd have conferences, and they had a thing called shuttle diplomacy, where this one would go there, and that one would go there, and everybody would meet in each other's countries. None of this is happening. It's a tweet war. So what happened? So we have oil went down, but basically the markets went up because the dollar fell from 98.40 to 97.50. So that's about a 1% drop in the dollar. So gold shot up, silver shot up, Bitcoin shot up, S&P futures are up. The indexes are up about 1%. AMD 20% spike from a deal they've got. And this is the thing. It's another reason we avoid these stocks right now. We can't get into stocks and buy them at 200 and sell short calls, and then the thing goes flying up to 428 in a month. If I came in March and bought the stock for 200 and sold the June 220 calls, I'd be pretty pissed off. It's 420 now, and I got short calls. So the question is, what's real, what's happening, and I don't know. Somehow we accept this. We accept the fact that they keep saying there's a peace deal, and then 2 days later, it's as if it never happened. It's just they don't even acknowledge that it's not that what they said didn't happen. They just say, then you wait till the weekend, and they're like, oh, here's a peace deal. We got a peace deal. But then there's no peace deal, and then a week later, here's a peace deal. It's insane. How are we supposed to do business like this? So quarter earnings. With 63%, so 63% of the S&P companies have reported. The numbers are amazing. Earnings growth 27%, revenue growth 11%. The beat rate is 84%. Is kind of normal. That's about normal for that. The highest earnings growth since 2021, when trillions of dollars of stimulus was thrown at the economy. Communication services, 30%, all Google. Information technology, 30%, all Mag 7. Consumer discretion, 20%, Amazon. One company is causing this bump in consumer discretionary. Materials, that's from the tariffs and the shortages in the Strait. And financials are making money hand over fist. Why? Because they're helping to finance all this shit. Who's not growing? That's where you got to be really concerned. Healthcare, bad earnings, not doing well. Energy, not doing well. Chevron had a weird problem. Chevron got killed on hedges because they pre-sold their production, and the costs have now skyrocketed, and they're on the hook to supply at a loss oil. That was unexpected. Disney had streaming issues. Peacock's loss doubled on streaming also. Linear TV dying loudly. That's a good note. My kids are Maddie's 26, Jackie's 24 or 5. Yeah. Wait, Maddie will be 26. Jackie's still 24. Okay. So Jackie's 24, Maddie's 26. And they do not watch TV at all. They watch their phones. They don't, we went to a hotel last year, and they had some friends also. So it was them and a couple of friends, and they were hanging out mostly in the living room, and then they had their bedrooms too. And I always have my TV on because I'm always got CNBC or Bloomberg or something's on. They don't watch TV at all. They did not put this is 4 girls, did not put their TV on once the entire weekend. All of them were staring at their phones. Whenever I came in, they're all looking at their phones. They're all watching things on their phones. They're all getting personally entertained. None of them once put on a television set. That's weird. Or it's weird to me, but it's not actually weird. That's just the way things are now. They have iPads maybe, and they watch the iPad, but it's phone or iPad. This is how entertainment is delivered now. And content, because they're not really all watching TV. They're watching TikTok. They're watching Reels on Facebook and things like that. It's not good long term for all these broadcast companies. It's not good. And it's going to change a lot. The media, it's a shame. And movies too. Movies are in huge decline. That's why they're charging like $25 a ticket now. I heard there's some tickets are $50, like in New York and stuff. It's $50 to go see a movie. Can you imagine? So, energy, critically underreported. Energy is the only sector benefiting from $90 oil, yet it's a year-over-year in decline. Why? Because integrated majors like Chevron and mark-to-market derivatives, blah, 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 blah. We just talked about that. So we like integrated super majors like Exxon and Chevron should do well. We already have Exxon. I don't like Chevron as much. Valero is a good one. MPC is a good one. So there's a lot of trade ideas in today's post. The bank earnings, we talked about that. JP Morgan, of course, as you know, I love. If they break over this downtrending line, they could be off to a good boost because they're trading at like 15 times earnings here. Because don't forget, in a normal year, IPOs will raise $40 to $50 billion in a normal year, and even that's kind of high. Could be $20 billion, but IPOs are like 40, 50 is a good year for IPOs. OpenAI is trying to raise $100 billion in an IPO. SpaceX is trying to raise $75 billion in an IPO. So just those two are $175 billion, plus after you do an IPO, there's knock-ons that can raise it like another 25 to 30%. So you're talking about $200 billion from two companies that are going public this year. That's 5 years worth of IPOs in two companies. So obviously Goldman Sachs and JP Morgan are going to be involved in any kind of deal like that. There's no way you can do it without them. No, other banks don't have that kind of money. The banks drop off very quickly, back below $1 trillion. Like after the top 10 banks, these guys don't even have $1 trillion. So you can't do hundreds of billions of dollars worth of IPOs if your whole bank only has $1 trillion total. Just can't handle it. So Goldman Sachs and JP Morgan do most of this stuff. Here's Blackstone as another big one. Oh, look at them. They're coming. See, this is what I call a triangle squeezy thingy. So it's going to violently burst out of this. It's getting trapped between the trend lines, and it's like breakout. Breakout where it goes faster and faster. It's like and then it gets really stuck until it pops one way or the other, right? So that's what's going to happen here. I think probably up. They had their earnings. Oh, I can't click on that, but I can get it over here. So earnings were a small beat. Not and GAAP earnings were worse, but they were okay. They're trading at 16x. It's not fantastic, but like I said, JP Morgan 13x. So they don't have a squeeze thing, but they're probably going to pop that and get back to the 15s or something like that, which is 10% higher than they are now. And then you've got Goldman Sachs. And again, another triangle squeezy thing coming up here. And they're at 14x. So JP Morgan, which is, as you know, my favorite, is the bargain of the group at the moment. This is scary. The consumer is really screwed, man. Target has these payment plans and things like that, which is doing very well. But they're basically buy now, pay later, and people are buying groceries and paying later. And when you're in that situation, if you get sick or you lose your job or there's some interruption or something like that, then what are you going to do? Now you have 18% essentially credit card debt that you can't afford to pay. And ultimately, that forces people to liquidate other assets like their car or their home or whatever, or remortgage the home at higher rates. Or these are cascading things that lead to recessions, and we're already really showing very big danger signs of that. The low end is paying for exit installments. That's not, it's not a good thing. So still though, off-price retail, TJ Maxx, Ross Store, Burlington, Kroger, ACI, Target, I love. There, look at this channel. Look at it. This is, by the way, these things are useful. When you look at when you look at a trading channel like this, and you see it going boom, 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 then you got a pretty good idea of when to buy and when to sell. Here I'm gonna sell less calls and buy more and sell more puts. Here I'm going to sell more calls and buy and sell less puts. Sorry. It's not that hard. If you're identifying a trading channel like this and you see it going up and down in the channel, you can make a lot of extra money just by your timing. But here, here's the real story. This is the Magnificent Seven. And this is the reality of the rest of the market. So I don't want to put a number. This is performance. I honestly don't know what that means. This is 35. So the big tech, the Magnificent Seven, have grown from 20% of the market cap of the S&P 500 to now 36, 37% of the market cap of the S&P 500. They've gone, this is say 100, and now they're at 175, right? So they're up 75% in 5 years or 6 years. These guys are up from the same 100 to 600, almost 700. They're up 600%. So these 7 stocks are dragging the S&P higher, even though the other 493 stocks are way down here. So 75% growth in 6 years is only 10% a year. It's less than that with compounding. That's the reality of the market. But it's the same thing as oil. That's why I wanted to make that point about oil before. It's the same thing as oil. It's too complicated to put on a soundbite on TV. When you're on TV, like even when I do BNN, they give me the whole freaking show. When I go on BNN, they give me a half hour. I'm the only guest when they do that show. Even then, though, even in a half hour, it really only works out to 24 minutes, like 3 8-minute segments is all the real time you have. And 8 minutes is not a long time to start explaining complicated things. I try to do it sometimes because you have to fit it in the block. And if I start going off on something, Kim will tend to steer me to her next question because she's got other shit to go to. She's got a list of things her producer told her, we're going to cover this, we're going to cover this, cover that. If I start going over on a question and talking for 2 minutes instead of 1 minute, she gets nervous. And nothing against her, that's just how TV works. And so you don't get the whole story. That's the problem, is you don't get even a well-meaning analyst, which I am one, you're not going to get the whole story because there's no time to convey it to you in television. And if it's done on a podcast, you will fall asleep before you hear it. That's the other problem. This is technically a podcast or a webinar, or whatever you want to call it, but the thing is, this is me talking for 2 straight hours, and it's almost over, guys. I gotta quit. So this is me talking for 2 straight hours, trying to fill in the blanks. And I hope you don't find it boring. This is me trying to fill in the blanks of what you're not getting you're not getting from the rest of the media. So it's the same thing as saying the U.S. uses 20 million barrels of oil a day. No, we don't. And it's the same thing as saying earnings were spectacular. No, they aren't. These 7 stocks are spectacular. They're making a freaking fortune, especially NVIDIA, who's got 50% profit margins on their goddamn chips, or 80% profit margins. NVDA. Okay. NVIDIA in 2023 and 2021 made 4, 9, let's say 7 billion a year, right? All of a sudden in 2024, AI comes out, 60 billion in sales, 29 billion in profit. Not a little bit more profit. From 7-ish to 29 billion is 4 times. Then 72 billion the next year, 120 billion the next year, 200 billion the next year, 270 projected the year after that. And that's out of 300, so 50%, yeah, it is 50% profit here, and 50%, not 50, yeah, 50 more, that'd be 540. So 50% profit. So they're making more than 50% profit margins because essentially they're profiteering. They're war profiteering. There's a chip war and an AI war, and they are selling the chips and charging insane amounts of money for the same chips. The same chips basically that they used to sell here, they are now selling them for just $50,000 instead of $5,000. And they are making money and more money and more money, and they are taking over the universe, making not this year, 120 billion this year, puts them tied with the rest of the Magnificent Seven. Next year, they're going to go to $200 billion. They're going to make an extra $100 billion next year. Extra. Where does the money come from? It has to come from other companies. Somebody getting this money is not getting it from, it means somebody else is not getting the money. It doesn't benefit everybody. The rising tide does not lift all boats. It lifts these boats. And these boats sink to the bottom of the ocean, underperforming by miles. It's like a 50% underperformance here. And this is like a 350% overperformance. And that's the story of S&P earnings, just like the story of oil consumption is all about how much we export. You have to understand those hidden mechanisms to really get the picture. So anyway, I gotta wrap it up. So I wanted to get to more of it. But earnings-wise, healthcare, travel, mid-cap, we've got trade ideas. There's so many companies with trade ideas here. And if you like any of them, let's talk about them in chat. But these are like so many ideas we can mine and figure out what we like and what we don't like. In fact, I already had Bodie give us a list of what he likes. Where it's too early to tell. So, the thing is, though, that you can't ignore the war. And if it's not really over, then things are getting worse every day. Then the consumers are getting squeezed every day. Then the inflation is getting higher every day. These are real things that are really happening that we're just basically ignoring because 7 stocks are doing well. And those 7 stocks are doing well because they're not really affected by the price of oil or anything like that. They will be starting to get affected by chips. If there's not enough sulfur and the chips can't get made and so on and so forth, there'll be problems and supply bottlenecks and so on and so forth. But none of it's going to be very obvious for quite a while, for a couple of months. And meanwhile, those kind of earnings, NVIDIA's earnings of $100 billion extra dollars, makes just NVIDIA, forget what the other guys are doing, but just NVIDIA making $100 billion extra dollars is basically more money than all of the rest of the bottom 700 companies, the bottom 490 whatever 7 companies in the S&P don't even make that much. So it makes all of the S&P earnings look fantastic because you're including these massive, insane gains into the picture. But and what's happening, and this is what happened in the .com days too. There were some great companies. There were companies making some great money and having, but they were getting ridiculous multiples. And what happens is, and we're doing it too, if everybody's being priced at 30 and 40 times earnings, when you find someone who's at 20 times earnings, you go, oh, 20 times earnings. But maybe they should be at 12 times earnings. Why? You're only picking you're only picking the least rotten fruit. Like when when you go for avocados and most of them suck, and there's a couple that are okay and maybe they're not great, but you really want to get an avocado, so you just pick the one that's like the least objectionable. That happens all the time, right? That's what this is like. You're picking the least objectionable stocks because you feel like you're missing out. And that's where it gets kind of dangerous. So, we have to, unfortunately, be more cautious in our analysis. We have to take really hard looks at things, and we have to really think about the business model and stress test them out and think about the negatives and the downsides. And I don't like to sound all negative about things. I don't like to sound so cynical about stuff, but this is exactly how I felt in 1999, and I did the same thing in 1999. I told people, this is not sustainable. You can't keep raising valuations like this. There isn't this much money in the world to support these valuations. And I was right, but I was wrong. All of 1999, the market went up 100% in 1999. Into 1998, we were already up 100%. We went up another 100% in 1999, and then the whole thing dropped back below where we started. When does this stuff happen? Who knows? So we're going to party like it's 1999. We've got plenty of longs. We're making plenty of money, but we're not overcommitting. That's the key to this thing. Don't overcommit and keep hedging. And I know it's annoying because, it would be great to just go for it and see what happens. But the people who went for it and see what happens in late 1999, they're the ones that got completely burned. And you never know when the shoe's going to drop. Anyway, thanks for coming, everybody. I appreciate it. We'll do it again next week. And wait, hang on. Let's see if anybody had one last question. I'm late to the webinar. Oh, dear. I'm late to the webinar. I don't know if you discussed Intel. Seems yes, it is way. I do not be in Intel. Talk to me in chat, JC. Okay, because that's a tricky one, and we can easily adjust that in chat. But I need to do it there. And Brad says he complained to BNN once when they only gave me a 10-minute segment. Yeah, it's not normal for someone to get 3 segments. I mean, it's ridiculous. They don't do that for anybody, but they love to have me talk. So I mean, it's honestly blessed because it's like I hate it when I go on and I just have a 1 segment and I got to try to say what I want to say in 5 minutes or less or whatever. I can't stand that. So that's why it's the only show I do. I mean, honestly, I don't do any other shows anymore. And I knew that would happen when I moved to Florida. I knew that I didn't expect even BNN to keep having me in. But leaving New York ended my media career basically. But anyway, thanks everybody for coming. I appreciate it, and we'll do it again next week. Thanks.